Morning, Michael. Thank you very much for finding time for us. Finding time from money making, actually. Money making has become so easy. How do you explain this risk-on rally? Simply because a Fed hike is off the table for the whole year?
I think, to be honest, what we're seeing is a bit of a short squeeze and a bit of over-optimism on the part of the market, thinking that, yes, because the Fed isn't going to be hiking, that all is well with the world. I think what they're overlooking is the fact that the Fed isn't hiking because all is not well with the world. But unfortunately, in the near term, the market isn't thinking rationally like that, and we are getting, quite a significant swing to the upside.
Okay, but how long will the good times last?
Well, I'm perennially gloomy, so I don't think that long. But the market can be irrational a lot longer than I can stay solvent. So it's possible that we'll continue to see an upside for the next couple of sessions. But I don't think it's going to take too much in terms of, a shock from corporate earnings or, aggregate economic data for the market to start realizing that, hang on, there is a downside to this. The fact that the Fed aren't moving isn't because they want to continue giving out free sweets and candy to everybody, but because the economy just isn't strong enough to handle it.
So will you sell into this global rally, Michael?
Personally, I would. Maybe not exactly at this level. I might let it go a little bit further first of all, but I certainly wouldn't be expecting it to go very far.
When are you expecting the Fed to hike rates? Because the expectation now has moved into the early part of 2016.
Well, for the moment, our house view is still sticking with December. Now, to be fair, we were saying December when everybody else was saying February or March. So we've actually been by far the most bearish in the market. What we actually think at the moment is that the Fed have really painted themselves into a corner. Their rhetoric has been so strong that they need to raise rates. It's going to be very, very hard for them to climb down because they've pulled the ladder up from under their own feet. That means they're very likely to have to do something they don't really want to have to do anymore, which, again, will be very negative for equity markets.
Okay, Michael, how do you approach a market like India? Here it wasn't just a technical rally. We've seen foreign inflows increase substantially. Do you think that a fundamental view is changing here?
Fundamentally, I'm positive on India. I think, as I keep saying, this global backdrop is negative in most places, but the particular combination of ingredients we've got globally is positive for India. What you want to see is low global commodity prices. What you want to see is markets looking for large domestic consumption-based economies, which is what India is. So on that basis, it's all looking pretty good. Unfortunately, I think a lot of it is already priced in. Just because the fundamentals are good doesn't necessarily mean that we can move that much further to the upside, given where equity markets are already trading.
So equities as an asset class, how much of returns would you expect, Michael, from here, say, for the next 6 to 8 months?
To be completely blunt with you, my primary focus at the moment is preservation of capital. I'm not looking to try and make any gains at all. So to my mind, if India outperforms everybody else by being completely flat for the next 6 to 8, 12 months, I consider that to be a real achievement.
Okay. Oil's found a bottom, you think, or is this just there again a technical support?
Well, as I always say, oil is a very complicated commodity, and most large investment banks have a team of 100 people who continually get the oil forecast wrong. At Rabobank, we specialize and decide that we'll have a much smaller team to try and get the oil forecast wrong. And our view is that basically we will see a gradual tick up towards the first half of 2016, but it is going to stay in a low range for longer than previously had been expected.
Do you expect more bad news from China?
That I certainly do. The Chinese economy is continuing to experience problems, and those problems are structural rather than cyclical. So, yes, we will still see further worrying headlines coming out of China, and that's to be expected. I don't see how that can turn around in the near term.
You mean the good times may last only up until Wednesday? Thursday, the Chinese markets open.
That's a good way of putting it. I did say that I was perennially gloomy. It's nice to actually try and put a date on that gloominess. That's entirely possible. I mean, obviously, it's very hard to pinpoint exactly when sentiment will turn again, but to my mind, it doesn't seem that it's sustainable at these present frothy levels for too much longer.
All right, we'll leave it at that. Michael Avery, pleasure speaking with you. Thank you very much for joining us and some very picturesque analogies.
Yes, indeed, and cautious on the global markets. He says he would sell into every rally and he prefers cash preservation at this point, doesn't expect too much returns from global equities. That is a reality check for sure.